Namaste, and welcome to This Explainer. Today, we're going to unlock the real secrets of financial mastery by diving into the Master Investor's Playbook. We're breaking down 7 time-tested rules for building lasting wealth. We'll be pulling heavily from absolute legends like Warren Buffett and Peter Lynch, and we're going to transform all those complex financial concepts into clear, actionable knowledge you can actually use. To truly understand the mindset of a master investor, we kind of need to start with a story. So picture this. A 10-year-old Warren Buffett hanging out at the Bend horse racing track in Omaha. But get this, he wasn't there to watch the horses. He would actually wait until the races were completely over, and then he'd meticulously scour the ground picking up all the discarded betting tickets. Why? Well, he figured that out of all the people who got careless or had a bit too much to drink and threw away their tickets, someone must have accidentally tossed a winning one. He checked thousands of tickets, literally one by one, and when he actually found a winner, he knew they wouldn't pay a 10-year-old, so he'd give them to his aunt to cash in for him. It's a funny story, but it brilliantly shows the incredible patience and dedication to finding hidden value that essentially defined his entire life.
Okay, let's dive into this, because that childhood patience, it didn't just disappear, it evolved. When Buffett started his investing career in his 20s, he obviously didn't have the internet. What he had were Moody's manuals, these massive, thick books with tiny print detailing the basic financials of hundreds of companies. And he would just sit and read them all day long. Even today, he spends 5 to 6 hours a day just reading annual reports and books. And this brings us right to rule number 1. Learn a lot, read a lot. So here's the quick roadmap for our playbook today. 1. The mindset of compounding. 2. Invest in what you know. 3. Size and focus matter. 4. Ignore the market timing. And 5. Free cash flow is king.
Starting off with phase 1, the mindset of compounding. We all hear people talk about compounding money, right? But the true, absolute foundation of wealth is compounding knowledge. By continuously reading and learning, your understanding of businesses builds upon itself year after year after year. As Buffett firmly believes, this compounding of knowledge is the most powerful tool an investor has, yet it's the one most people completely overlook. Simply put, the more you learn, the more you earn. Let's move to and see how this builds into our second phase. Invest in what you know. Now, this is absolutely wild. Peter Lynch reveals this story in his book, Beating the Street, about a group of 7th graders at St. Agnes School. With their teacher's help, they created a portfolio of 14 companies. Over 2 years, these kids achieved a massive 70% return, completely crushing the S&P 500 index, which only did 26% in that same time. How on earth did a bunch of 12-year-olds beat the market? By strictly following rule number 2, know what you own. Their rule was super simple. Never invest in a company if you can't explain what it makes or what services it offers simply enough that you could draw it with a crayon. If they couldn't explain it, they just couldn't invest in it. Which naturally leads us right into rule number 5. If you like the product, chances are you'll love the stock. Peter Lynch actually learned this the hard way. His daughters absolutely loved wearing Gap clothes, but he just never thought to look at it as an investment. And he completely missed out as the stock grew 13 times over in a single year. So the next time he took his daughters to the mall, he paid close attention. They walked right past the Gap and went straight into this packed store called the Body Shop, buying up lotions and creams. He went to work the next day, pulled the Body Shop's annual reports, saw their aggressive, highly profitable global expansion, and recommended the stock. And guess what? It multiplied in value perfectly. Everyday observation is literally a superpower. And what's really interesting is how perfectly this product-first approach applies everywhere, especially in the Indian market. Just look at Royal Enfield, famous for its bullet bikes, a product beloved by millions. Its stock price surged from a mere 1 rupee and 22 paise all the way to 2,525 rupees. Or Britannia Industries, a total staple in almost every household. It went from 8 rupees and 23 paise to over 3,580 rupees. To put that into perspective, if you had invested 1 lakh rupees in Britannia during its early days, it would be worth around 62 lakhs. Great. Highly visible products very often translate to incredible public companies. Let's transition to our third phase. Size and focus matter. This brings us to rule number 3. Over the long term, it's often way better to buy stock in small companies, and the simple math explains exactly why. Think about it. If you invest in a giant like Reliance, which already has a market cap of over 16 lakh crore, for your money to multiply 10 times, Reliance needs to reach 166 lakh crore. That is a monumental, almost impossible task. But a small company starting at 1,000 crore valuation, it can much more easily hit 10,000 or 20,000 crores. As great investors often point out, the bottom continuously gets emptied out. Huge institutional investors can't effectively invest in tiny companies because a 10x return on a small sum just won't move the needle for them. And that leaves a massive opportunity for everyday investors like us to find these high-growth small caps. So you might be wondering, how many of these stocks should you actually own? Well, according to Warren Buffett, if you find just 3 wonderful businesses in your entire lifetime, that is more than enough to do incredibly well. 3. This is rule number 4. Hold no more stocks than you can remain informed on. Realistically, the human mind can only track and deeply understand about 8 to 15 companies at a time. You want to know these businesses so inside out that you feel like you've personally signed a 100-page partnership agreement with the owner. Keep your focus tight. Moving right along to our 4th phase, ignore the market timing. Now, rule number 6 comes with a very strict warning. Trying to time the market is a massive trap. People exhaust literally all their energy trying to guess what the market is going to do tomorrow, when exactly to enter or when to exit. And you know what? 99% of people feel miserably at this. The best investors don't waste a second on this curse. Instead, they focus entirely on finding fundamentally good businesses whose products the public actually needs. Because if the business genuinely grows over the long run, the share price will absolutely follow that business growth rate. Focus on the business and just completely ignore the daily market noise. Finally, we arrive at our 5th theme, free cash flow is king. So consider this for a moment. What actually happens to a company's reported profit? We so often look at earnings and immediately think, great, that means cash in the bank. But it doesn't. When companies publish their financial reports, they can legally include money in their profits that they haven't even received yet, like goods they sold on credit. This can completely cloud your analysis. Standard earnings simply do not tell the whole story. And that brings us to our final rule, rule number 7. Warren Buffett's absolute favorite indicator is free cash flow. Let's break this down really simply. Say your business reports a profit of 1 crore rupees this year. Awesome. But the nature of your business means you absolutely have to buy a new machine next year just to keep the lights on, and that machine costs 99 lakh rupees. You have to spend that money. So your actual usable profit, the real cash you are actually free to use, is only 1 lakh rupees. That is your free cash flow. It's the operating cash flow minus necessary capital expenditures, the real physical cash left over. And this brilliantly illustrates exactly why this metric is absolutely crucial. Look at this data from Reliance in March 2021. If you just glanced at the standard profit and loss statement, you'd see a highly positive reported earnings of over 49,000 crore rupees. You'd think they're practically swimming in cash, right? But if you look at their free cash flow for that same period, it was actually negative 13,523 crore rupees. Now, a negative cash flow doesn't necessarily mean a company is doomed. Maybe they're just heavily investing in future expansion, but it is the ultimate truth teller. It proves that to really understand a company's health, you've got to read the annual reports, listen to the earnings calls, and follow the physical cash, not just the paper profits. All right, let's take a quick mental snapshot of our complete master playbook. 1, read continuously to compound your knowledge. 2, know exactly what you own. 3, look for the high growth potential in small caps. 4, keep your portfolio tightly focused. 5, buy stock in companies whose products you already love. 6, completely ignore the urge to time the market. And 7, always remember that free cash flow is king. I want to leave you with a final, slightly provocative thought to consider today. If you had to sit down right now and explain every single investment in your portfolio to a 7th grader, using simple terms they could easily understand, could you do it? If not, well, it might just be time to revisit the Master Investor's Playbook. Thank you so much for joining me for this explainer. Keep reading, keep compounding that knowledge, and we'll see you next time.